So now I want to introduce some strategies for budgeting. So what are some of the avenues that we can take, the actions that we can take to, again, increase our discretionary cash flows and move us towards greater financial freedom? The first thing is that we have to look at adjusting the timing of our cash inflows and our outflows so we know our cash inflows are going to be occurring every other Friday beginning in April of 2015. So we know with certainty when those cash inflows are going to change and when they are going to have a direct impact on how we are being paid. Ultimately, we have to, again, revisit that calendar that you saw earlier in the presentation to make sure and ensure that our cash outflows are timed appropriately. So we can look at some of the discretionary expenditures that will help facilitate ensuring that our debt payments are made or our fixed costs are made appropriately and during the correct time period. So what are discretionary expenditures? These are areas of budgeting that you can have an actionable change to reduce spending in each of these categories. So things like utilities, we can all, I yell at my kids all the time about turning off lights. We can all do a better job of turning off lights when we leave the house, increasing the temperature in the summer and decreasing, our heating costs in the winter. Most service providers will also allow for budgeting. So I encourage everyone to take advantage of these fixed payments that you would receive over the 12-month period, because this really will help aid you in your cash outflows, especially during those winter months. We have a long winter ahead of us, and implementing that budgeting will help you even out those cash outflows over the course of the year. Things like telephone service, cell phone service, and cable. These are items that it is really important to revisit your service contracts. Oftentimes we begin a service contract with a provider because they are offering some kind of incentive program, but after a certain set period of time, usually 12 months, our costs are increased in these categories. If you contact those service providers, oftentimes they will be willing to extend those. Or if you were to switch service providers, this is a low opportunity cost to you, but it could increase your savings in those categories dramatically. Food and clothing and entertainment expenses, these are all easy expenses to control. Eating at home more, taking your lunch to work, reducing your overall entertainment expenses, watching movies on Netflix as opposed to going to the movie theater. These are easy changes that you can make in your day-to-day life that will increase your overall quality of life and reduce your spending in each of these categories, because again, we're moving towards increasing your discretionary cash flow. Other easy ways, well, maybe not necessarily as easy as just simply, not eating out as much as you're used to, are things that we should all be evaluating periodically to take advantage of, especially right now, all-time low interest rates. So this revolves around increasing your discretionary cash flows by refinancing and or renegotiating your debt obligations. With interest rates at all-time lows and with many consolidation programs currently available, both governmental consolidation programs as well as private consolidation programs, it has never been easier to consolidate and begin to pay off your debt in a timely manner than it is today. So the first type of major debt burden that many families have to deal with or face is student loans. Okay, so with student loan consolidation, while this may extend your repayment period and increase your overall interest expense over the life of the loan, it also allows you greater flexibility and greater freedom in making your payments, because your overall payment is going to be less on a month-to-month basis. The other good mechanism of student loan consolidation is that it allows you to fix your interest rate. Most student loans today are variable rate. If you do fall into that category of having a variable rate interest payment, again, these are going to be payments that are going to be sensitive to inflation. So by fixing that interest payment, it just simply allows you greater flexibility and greater freedom. There are no prepayment penalties. So if you have additional cash flow during certain times of the year, you could make additional payments and pay that student loan off earlier. Auto loan refinancing, on average, the current rate for what we would consider to be good credit is about 3.5%. So if you are making interest payments above 3.5%, it may be a good time to refinance your automobile liability. Usually these refinancing programs are just simply filling out a form online. They run a credit check, and within a 24-hour period, you have your answer, and it's quick, it's easy, and it's a great mechanism to decrease your costs associated with making those automobile payments. Mortgage refinancing is a little bit more detailed. There may be additional closing costs because effectively, again, that loan is being paid off and you are extending a new line of credit. However, when I refinanced my mortgage, I saved $500 a month because of the reduction in my overall interest payments. Furthermore, if you're paying things like private mortgage insurance, if the value of your home has gone up, by refinancing, you are able to eliminate those costs and those expenses. And it's going to allow you, this is our greatest source of freeing up discretionary cash flow, is taking advantage of low interest rates and refinancing our mortgages to increase our overall level of discretionary cash flow and reduce our overall debt payments. So our current rates for a 30-year fix fall within, depending on the time period that you're looking at. There's been a lot of fluctuation in mortgage rates lately, but they typically have been falling between 4% and 4.27 or 4.3% for a 30-year fixed mortgage. And then they're even lower, about 3 to 3.5% for a 15-year fixed mortgage. So I encourage you to look at your current interest payments that you're making on your mortgage, especially if you've been in your home for an extended period of time, and see if it might be worth refinancing your mortgage to increase that discretionary cash flow and reduce your spending in that particular category. Finally, we want you to encourage you to look at your credit card current credit card debt. The average American carries over $10,000 in credit card debt, and just simply is maintaining those minimum balances on those credit cards. So we want to encourage you to contact your service providers and potentially think about consolidating your credit card debt as well. Most service providers have consolidation programs available to their consumers, but they're not going to give it to you unless you ask. So this will enable you to set up a repayment schedule that you are comfortable with and move you toward eliminating that source of high interest debt. So all of these renegotiations, especially when we're looking at mortgage refinancing and automobile refinancing, are going to depend on your overall level of credit. So we need to make sure that we are revisiting our credit report at least on an annual basis, not only to ensure that identity theft and fraud has not occurred, but also to make sure that when interest rates change, we are able to take advantage of those by maintaining good financial standing with all of our creditors. So you can receive a free credit report at annualcreditreport.com. But we also encourage you to periodically pay for your credit score to make sure that you are maintaining that overall good standing, which will enable you to take out future loans. It will enable you to refinance your current debt and overall move you towards greater financial freedom. So again, your current credit score is going to impact your ability to refinance your current debt. And so it's important to make sure that you understand what is going into your credit score, make sure that you're making those payments in a timely manner, and this will help better facilitate your debt management moving forward. So this chart provides you with an indication of how an average American spends their money. And again, there are some general assumptions, but for the most part, our largest expenditures, as you will see, fall into our housing expenses and our automobile expenses and food. So these are going to be our primary expenditures. Many of these are fixed expenses, but again, we can take steps and have mechanisms in place that can reduce our overall levels of debt as we move through our life cycle, which will enable us to free up additional cash flows in the future. And we live in a society where we like to kind of look at how we are spending money. And so this chart provides you with a nice indication of how an average American spends their money. So I encourage you all to compare your current expenditures to that of a typical American family to see if this could possibly provide you with some ideas of how you could reduce spending in certain categories or increase savings in other categories.